parts. Okay, so today we are going to focus on chapter 5. So as you have done this previously, we were focused on looking at the business combination. So what happened when we acquire a new company? We develop a parent subsidiary relationship, and then we have to look at it from the business combination purposes, what you need to do at the time of the acquisition. So now what we're going to do is we're going to take that further, saying what happened after the business combination, how does companies maintain their records independently as well as for the consolidation purposes. I'm going to divide this session, chapter 5 sessions, into different parts, so that way if you need to focus and read through the sessions, you can do that in the parts. So most likely the first part that I'm going to do is I'm going to focus generally about different methods we have where subsidies and parent, how do they maintain the bookkeeping or accounting, and then further we look at the impairment testing of all the assets at the consolidation level, and then we'll look at how those processes work. And after that we will jump into another session which will more focus on consolidation, as what does the consolidation happens on an annual basis after the acquisition. So these are your objectives that we have from this chapter that we have to make sure we understand by the end of the chapter 5. We want to make sure we know how to do the impairment testing, prepare the schedule. So as you know that what we have been doing previously is we look at the acquisition differential and then we allocate that between the different assets, and then anything left we do pass that over to Goodwill and recognize that on the consolidated statement. So now what happened is we have to look at that acquisition differential and maintenance schedule, how we do the allocations. Then we look at the consolidation using the fair value enterprise method and the identified net asset method. Then we further look at how the journal entries work in regards to the investment account under the equity method, analyzing and interpret the financial statement when we do the acquisition. And then there's two appendix we have which you guys can read through, and then we'll do a separate recording of that session and discuss that in class on high level. And then if you have any questions, we'll discuss that in class, and I'll see if I can post that video as well, focus on the appendices. So the appendix 5A focus on the impairment test for the goodwill in a complex situation. So we are going to do some basics impairment testing in goodwill in this chapter, then the appendix will go into the complexity of that impairment. And then 5B will focus on the consolidated financial statement after the acquisition using a working paper approach. So first we're going to start with as methods of accounting for investment in a subsidies book. So now regardless of whether there is a consolidation or not, the companies do maintain their financial statement independently. So now when they're doing the investment, they still have to maintain a record for the investment they had. So if the parent bought a subsidy, that is an investment on the parent's book. Now how do they account for that investment? So the parent will produce his own financial statement, and they can decide to use either the cost method or the equity method for reporting of that investment. Okay. So you know that from chapter 2 that cost method is less work, because when the dividend comes you only record investment income and that's pretty much it. Whereas the equity, you have to prorate your investment and then show your income in the investment, so it becomes more time consuming. So if you know that we're doing a consolidation, most of the companies will use the cost method for recording the investment of subsidy, but you have the choice between cost or the equity. So in that method, the cost method records income and the investment's right to receive a dividend, whereas the equity captures the investment shares when the investees shareholders equity. So whatever their portion, they will recognize that as an investment, and then when the dividend gets paid out, we will decrease the amount of investment. So the equity method captures the net income effect of any adjustment that was made on the consolidation level. So at the end of the consolidation, that what we're going to understand is when we do a consolidation of net income, it will come out to the same result that it would have if we use the equity method. Okay, so therefore it makes sense to use the cost method, but that's entirely management decision whether they want to use cost method or the equity method for recording investment. we must differentiate between accounting for internal record and the external record. So as I mentioned earlier, parents and subsidy, both of them should uh, should maintain their own financial statement for internal purposes. Okay, management wanted to know how the company is doing, but when it comes to the external reporting, if the company is complex, it has various investments, which are their subsidies. For external reporting purposes, they do have to do the consolidation. So we should understand what are the internal financial statements which are only used for internal purposes, and then obviously the external financial statements must comply with the standards before it goes to the public. The entity could issue non-consolidated financial statements to external users in addition to the consolidation. So you can add those independent financial statements as a supplement statements along with the consolidation. So that could be there, so that way users have more information about the performance of independent entities. The next we have dividend income and the equity method income. So dividend income and the equity method income from the subsidiary are usually not taxable. So this is something that relates to taxes. So when the companies are filing their taxes, they don't file the taxes based on the income that's coming from the other companies. So I'm not sure if any of you guys have done the tax courses. So in tax, especially in advanced tax accounting, an advanced tax course, you will understand that the intercompany dividends are non-taxable. So what happened is it get taxed at a part 4 level, but one company will pay taxes, the other company will get a refund for that. So eventually there is no dividend that pays out on the intercompany dividend. So the dividends that are paid out either from the subsidy, or even if we have realizing the income from the equity method, those entries are eliminated for the tax purposes. Consolidated net income will be the same regardless of whether the parent used cost method or the equity method. So when we do in consolidation, we eliminate all the intercompany transactions. So that means that when we do a consolidation, we do a consolidation on a line by line basis, and any income that was recognized between the companies are eliminated for consolidation. And then when we combine them together, it will give you the same result as it could be regardless of which method you're using for reporting of the investment. Is it either the equity or the cost method? Consolidated income and the retained earning. So now, how does the consolidation of the net income and the retained earning works? So as I mentioned, the net income gets consolidated line by line. So what we do is we look at the investment income from subsidy and replace that with the revenue and expenses on line by line basis. So if, for example, if we're using the equity method, we already recognize the company's subsidies net income in our statement. So what we do is we eliminate that income. Instead, what we do is we consolidate that line by line. So what we do is we go in, look at the net income for the company, look at all the sales and the expenses, all the revenue and expenses, add them together with parents' income, and then show them as a combined amount. Okay. So when we do the allocation, what you guys will do is we will take up the example later on as well. So what you will see is that you will have income from the parent, and then you will add the income from the subsidy. And if there's NCIs, we will show them NCI and do the calculation for NCI separately, and that will get reported to the NCI account versus reporting into the consolidation. So that's something that you have to keep in mind if the investment is less than 100%. Then the other part you have to do is you have to keep in mind you have acquisition differentials sitting on that working paper. So this is not sitting at the subsidy or the parent level, this is sitting at the consolidation level. So now what happened is the acquisition differential also need to be written down. Okay, so you know that the acquisition differentials gets allocated to different assets, and then what happened during the at the reporting time, you evaluate each of the assets. If there's assets that need to be depreciated, we depreciate that and record it. If any asset that need to be written down, we write that off and then we recognize that as the consolidation level. And if there is anything else that need an impairment, we do an impairment write-off as well, and then show them in the consolidation level. So technically we will do that up until the time the acquisition differential is written off. Consolidated retained earnings reflects only parent shares of combined companies' retained earnings. So when we look at the retained earnings, that simply reflects the retained earning of a parent company. Okay, so testing goodwill and other assets for impairment. Now this is an important part, and this is something new that was launched in 2011 when the new standards came in. They said the impairment test for long-term intangibles and the long-term tangible and intangible assets changed with the adoption of IFRS. And there was a special section that was introduced, IAS 36, which talks about the impairment of assets. So any asset that has the impairment rules applicable that need to be looked at the consolidation level as well. So at what time do you realize that the asset need to be impaired? It will get impaired when the carrying amount exceeded its recoverable value. Okay, so if that is the case, then you realize that there is an impairment, and then you write that off. The recoverable amount is higher than the fair market less, so that's another reason that could be an impairment, that the recoverable amount is higher of the fair value less cost of disposal and the value of use. So if that is the case, then there is an impairment. So then it also says that it is possible for an asset not to be impaired at the subsidy level, but to be impaired at the consolidated level. So there may be some assets that are showing, such as goodwill, that exists on the consolidation level, but there is nothing sitting on the subsidies book. So we may see that there is no impairment for the subsidy, but when we consolidate, we see some of the factors that says that there is an impairment. So we have to look at that at the consolidated level. So if you don't see any impairment that's happening on subsidy, doesn't mean that there is no impairment testing required at the consolidation level. So IAS 36 has different requirements for impairment testing for the following types of assets. So now the impairment testers has different rules depending on the type of assets we're looking at. So there are 3 different parts they divide that into. The first part that we have is the property, plant, and equipment. And we also look at the intangible asset that has a definite useful life. So if we have a patent or a copyright that's good for a certain number of years, that gets applied to the same rules as a property, plant, and equipment. Then there's another one is the intangible asset with indefinite useful life or yet not available for use. So if there's any asset that is intangible, such as goodwill is separate, such as if you have a copyright that has no definite life, you have a patent that has no expiry, those things could belong to that category. Or if there's any asset that you've been investing into and that is not available for use, that because this could be a research and development that you doing, or you're in an initial step, that could also be applicable in that category. Then you have cash generating units and goodwill. So we know that when we do the business acquisition, there are chances that we will have goodwill. Okay, and then if we have cash generating units and that has separate goodwills allocated, that need to be looked at and then identified for the goodwill. And if there's an impairment, then you have to follow the procedures to write off that impairment loss as well. So now there are 2 steps that need to be done for impairment testing. The first thing that you have to do is you have to assess and look at if there's any internal or external indicators that shows up that there's an impairment of the asset. Okay, that requires a lot of judgment. Okay, so management or the person who is evaluating these assets, they will look at these independent accounts that's sitting on the balance sheet and see if there's any indications, whether it's internal, which is within the organization, asset got damaged or something happens to the technology, or sorry, technology could be the external factor. Internal factor could be that management feel that the product that they're using is not efficient, or anything that indicate that the asset is not doing what it's supposed to do, then it is an indication that there's a impairment of the asset. Okay. Then we also look at the external factors such as change of technology, or the product has no fair market value, and there is new technology that came into place, or the product is not in demand anymore. So all those factors could be considered in step 1 to determine if there is an impairment. Okay. So when you are doing step 1, you must, for reporting purposes, you must document the testing if you have done any testing to make any judgment call whether there is an impairment or not. So materiality plays a very important role when you're doing step 1. So if the amount of asset that is sitting on that is huge, so you may have to make sure you do your due diligence to determine if there is impairment or not. Okay. Once you determine if there is impairment, then you move into the step 2. But if you determine there is no internal or external indication about the asset being impaired, you will stop at step 2 and then move on. Now, if there is an indication, then you move into step number 2. Now, step number 2, what do you need to do? So what you do in step number 2 is you look at the recoverable amount and you determine that and compare that with the carrying value of that asset. Okay, so you need both of these values to determine what happened with the impairment. So if the recoverable amount, okay, so recoverable amount is what you can get out of that asset, is greater. So if the recoverable amount, for example, is greater, that say, let's say it's $1 million for recoverable amount, is greater than the carrying value. So the carrying value, let's say, is $750,000. Okay, so that means the value of that asset is higher than the carrying value. So that means there is no impairment at all. So you don't need to do anything. Okay. But if it happens the other way around, that your asset was $750,000 carrying value, but the recoverable amount came out to $500,000. So now we say, okay, well, this asset is not worth what the carrying value is showing in our financial statement. That is an indication that there is an impairment loss. Then you have to take that to further and do an impairment loss of that difference. So you always have to push down the value to the actual recoverable amount and realize that impairment loss on the income statement. So, okay, so we have a slide here that actually tells you what are the internal and external factors that can be used to determine the step number 1 to see if there is an impairment loss or not of that particular asset that you're looking at. So external factors always look at the factors that are outside the corporation, which is more of the market or the customer. Internal factors are mostly within the organization, such as management or any obsolescence of the asset that happened. So now there are a few examples here, but there could be more stuff that you may have to look at. So for external factors, we look at the asset's market value. If we see that the value of that asset has been decreased significantly, that's an indication. Okay. It doesn't mean there is an impairment, but that's an indication that there may be an impairment. Then you have to look at the test and move into step number 2. Change of technology, that's always happen when you have products that you purchase and then the technology change, and that product may not be with this may not have the same value as it was in the initial stage. So you have to look at that and then move into step 2 if it is the case. Significant increase in the market rates of return has occurred that cause reduction in the value of the investment. For example, you bought an investment and then you're expecting a 10% return. All of a sudden that investment is not giving the same return as promised, and then what happened is in that case that investment may not be worth what it could be at the time when you initially purchased. So if there's any changes in the rate of return for that investment, that is also an indication that this investment could be impaired. The carrying amount of the net assets of the entity is more than the market capitalization. So if the carrying market of the net asset of the entity is more than the capital, that was out there, that is also an indication that investment. So this is mostly investment in the other companies. So if that is the case, then you have to look at the recoverable amount. So now, what are the internal factors? There's evidence of obsolete or physical damage of an asset. That's right away. When you are looking at inventory or any assets, you have to do a physical inspection as well. And then if you see anything that's wrong with that asset physically, you may have to look at it as a impairment. For moving to step 2 to do an impairment testing. There has been significant adverse change in how assets used. So if there is a change in use of the asset, so the asset was used on one product line and started using into different product line, it may demolish the value of the asset. So you may have to look at from that part as well. Evidence has a reason that economic performance of an asset will be worse than is expected. So you also look at the economical factors. If the expectations were too high and that the asset doesn't meet that expectation, then you have to look at whether this has the same recoverable amount than it was previously. Carrying amount of the investment subsidy in a separate entity financial statement exceeded the carrying amount of the consolidated financial statement. So when you're doing a consolidation, you may realize that the carrying value that you have on the financial statement is actually and very different than what it was initially. That is also indication that that your investment is need to be impaired. So when we do a consolidation, we talked a little bit about it. Is you always eliminate your investment account against the shareholders' equity, common shares, and the earning of the subsidy. And then if there is a significant change in the net asset, which is asset minus liability, which is the shareholders' equity of the subsidy, then there's an indication that there is an impairment of that investment as well, which need to be realized. That means your losses need to be recognized as well. If your dividends exceeded the income from the subsidy, so if the company didn't have much of the earnings left and they are paying the dividends and then creating a deficit, that's also an indication that there is an impairment of that investment. Okay, so you always look at those these factors. There may be a few other factors that be considered using the management judgment call, but these are the most important ones that definitely need to be looked at and to do an impairment testing. So this is mostly done in a step number 1. Now, those were more applicable for the property, plant, and equipment, and the assets, intangible assets that has a definite life. Now we're going to look at the intangible asset with the indefinite useful life. So any intangible that is not subject to the amortization is tested for the impairment. That's a common thing. So if the asset doesn't have a useful life, that means it has indefinite life, that means you cannot amortize that. So if you cannot amortize that, then you simply move that straight into step number 2 to see to do your impairment testing. Okay, and then when you do an impairment testing, you see what you need to do is when certain criteria are met, you compare the recoverable amount with the you do your impairment testing, and to do the impairment testing, what you have to do is you have to come up with the recoverable amount, okay, and then you compare the recoverable amount with the carrying amount and determine if there is an impairment or not. Okay, so in this case, you don't have to do any you're not going to do step number 1. So you know that it is there's an intangible asset that has no definite life. You move directly into step 2 and do the recoverable, do the impairment testing. Okay, so when you're doing the impairment testing, now it could be time consuming and also be costly to do calculate the recoverable amount. Okay, sometimes you may have to bring the specialist to calculate your recoverable amount for that particular asset. So in that case, what the accounting standard says that if the value of that asset is not significant, it has to meet certain criteria, which is on your test book. It's mostly talks about the materiality of the asset and and the useful of that asset, how useful is that for decision making of the users. If those conditions does met, instead of calculating a recoverable amount every year, you can use the recovery amount that was there for the previous years and compare that with the current year value. Okay, so I mean compare that with the carrying value to see if there is an impairment exist or not. Okay, so it is always advisable to do a comparison of the current recoverable value, but if the assets are not material, you can do those new recoverable amount on a periodic basis, not annual basis. Doesn't require to be annual basis, as long as it meet those criteria that is in your test book. Okay, so from a theoretical side, always look at the materiality of that account that you're doing the impairment testing on. So the next one we have is a cash generating units and goodwill. So now the companies may be divided into the different parts or different units, or we call this divisions. Okay, and they may have their own goodwill or some of the assets. Some of the goodwill at the time of the business combination may have been allocated to different units instead of allocating to the entire company. So in that case, you have to do the evaluation of those units separately and determine if there is an impairment of those goodwills that happen to those units. A business divides itself into separate cash units, each of which has a cash inflow from an asset or a group of assets that are largely independent of the cash inflow from the other assets or asset groups. Okay, so that's where when the companies that are more focused on those particular type of assets or the units, they may prepare the financial statements that shows the net revenue and expenses unit by unit to see the profitability. Okay, so in that case, then you have to do these testing on those group of the assets versus looking at the full picture of the company. So if that is the type of company that you're looking at, you will look at the goodwill result from the business combination. So we know that we do calculate the goodwill when we do a business combination. Then what happened is that goodwill doesn't go on the financial statement as a full amount. It can divide it between the different cash units, and then that will get evaluated on an annual basis thereafter. So when we have a goodwill, so we do the same process to calculate the goodwill. Then each unit goodwill is allocated must represent the lowest level applicable, will not be larger than the operating segment determined in accordance with the IFRS 8. So when you do the calculation of the goodwill, then you allocate that goodwill between each unit. You also have to keep in mind that you allocate in a way that you not allocate more than what the actual operating segment's net worth is. So you want to consider that part when you're doing the allocation at a business unit level. So goodwill is allocated to cash units as follows. So now you have to go through those steps when you're doing the allocation to the different units. The total value of the subsidy is allocated to each separate unit. The fair market value of the subsidy's net asset is also allocated to each cash generating unit. For each cash unit, the allocated value is compared with the fair market value of the unit's net to the identified net asset, and the difference is considered to be a goodwill for a cash generated. As sum of the cash generated goodwill should equal to the acquisition goodwill of the subsidy. So what you're doing is you have done the calculation to calculate goodwill at the acquisition level. Then what you do is you compare that goodwill and then do the calculation of independent business units. And same way that we were doing the calculation, what you do is you look at each unit and compare the fair market value of the net identified assets and compare with what the fair market value of the subsidy net assets are. And the difference will consider to be a goodwill for each unit. In hypothetical case, your goodwill that you calculate for each unit should equal to the total acquisition goodwill of the subsidy. Okay, because what you're doing is you allocating that value that you purchase the subsidy at between each unit, and then the asset that you identify as an overall for the entire company, you allocating the fair market value of those assets to the independent unit as well. So what you're doing is you're taking the same numbers that you have done previously. Now what you're doing is you're allocating and creating separate columns and dividing those values between different cash units. Okay, so end up with the same goodwill, but now that goodwill will be allocated between different cash units that the subsidy holds. Now the goodwill impairment test is complex and often requires significant professional judgment. So now when we allocate, now we know that there is a goodwill that exists and it shows up on the financial statement and as a combined number, but it's divided between different cash units. Now what happened is we need to do a testing to see if those goodwill does exist or not. So goodwill impairment is always a complex situation because you always have to look at the net cash flow that could come in from the company from the future and determine if that goodwill still exists at the time of the reporting period. So before goodwill impairment testing, individual assets should be tested for impairment and any losses recorded. So goodwill is the last asset that you want to do the impairment testing on. So you must have recognized the losses that there are on any of the previous assets. Then what happened? Then the recoverable amount of each cash unit is compared to its carrying value. So we, in the previous step, we determined what the carrying value of each assets were, net identified assets were for each cash unit. So we know the value of those assets. And then what we do is we find out the recoverable amount for each cash generating unit. Okay, and then you compare that, and the same process, same rules applicable for the impairment of the goodwill. So you compare the recoverable. If your recoverable amount is higher than the carrying value, that indicates that there is no impairment because your goodwill still exists. If happens the other way around, if you find that the recoverable amount is less than what the carrying value of those assets are, then obviously there's an impairment loss, and that must be recognized and reduce the carrying value of your asset. So now when you're decreasing, so now what happened is we need to do an impairment loss. So we recognize the impairment loss, and now what assets are we gonna decrease? So the very first thing that you're gonna look at is you're gonna see, okay, well, the recoverable amount is, for example, $1 million. The recoverable amount is 500,000, and the carrying value is sitting at 750. So we know that there's a $250,000 of impairment that need to be written down. Okay, so that is an impairment loss. Now you have to look at what assets I'm gonna impair. So the first thing that you're gonna look at is a goodwill. Okay, so if your goodwill sitting there for $300,000, you write off that by 250, so you only have 50,000 remaining in a goodwill. What if there was no 300,000 sitting there? So there's only 100,000 sitting for as a goodwill. So what you do is you actually write off the 100, and then the other gets allocated to the other carrying value of the assets, because you still have to write off the full $250,000 of impairment loss. Then what you do is you look at all the other carrying assets that exist on the company's financial statement and prorate that and allocate among all the assets. Okay, that is something that need to be done for impairment of a goodwill. Now, can that impairment loss be reversed? Yes, it could be reversed. Impairment losses on assets other than goodwill can be reversed only to the extent of the pre-loss carrying amount of the intangible assets. So if the impairment losses were happen to be on the tangible assets, that can be reversed back, but it can only be reversed back to the losses that were recognized previously on those assets. Okay, so you always have to make sure that when you're doing impairment losses, you maintain a working paper that shows how much impairment losses did happen, and then if any indications that happen that the value of the company is, or the assets value has gone up, then what happened is you can write off, reverse back the impairment losses that were recognized previously. So the two-step process in step 1, entity assessment, where there is an indication that impairment loss either decrease or no longer exists. If decrease indicated the first step, in the second step the recoverable amount is determined. And the impairment loss is reversed only if there has been change in the estimate used by the determined assets recoverable amount, not in the present value of a future cash flow, has increased solely from the passage of time. So you don't look at the value just because the interest rate is gone. So you have to do that from the cash flow perspective, or from the indication if there's an indication that the actual value of that asset has gone up. Reversal impairment loss is reported in the net income, obviously, because we recognize the impairment losses in the net income. So the reversal will also happen to be in your net income as well. Reversal of an impairment loss for cash generating unit must be allocated to the asset of unit prorated with the carrying amount of those assets. Same way that we did the impairment losses of Goodwill. So reversal of the impairment losses from the cash generated must be allocated to the assets of the prorate with the carrying amount of the asset. So you look at, so if there's a reversal, you do the same way as well. So you're not going to go back and put that amount into the Goodwill. So you, because we cannot reverse back the Goodwill, but we can reverse back the payment that we recognize in the assets using the prorate of the carrying value at the time when we're doing the reversals. So the last part that we have in regards to the impairment losses is disclosure. So one important thing that regarding the IFRS is they are very strong on the disclosures. So they want to make sure that there's enough information for the users when it comes to the impairment testing and the impairment losses that has been recorded, or the reversal of the impairment does happen. So there are extensive disclosures that always goes hand on hand with the IFRS standards. So here are the few disclosures that must be there. For each asset class of asset, the amount of impairment loss and reversal of impairment loss segregated by amount recognized in the net income and the amount recognized in OCI. So there may be some assets that the impairment of those assets doesn't go directly into the net income. They may go into OCI. So if that is the case, then your disclosure must identify the amount of impairment does exist and how much of that is sitting in the net income and how much of that is sitting in the OCI. The event and the circumstances that led to recognize or reversal of the impairment. So if the management determines some indications, then you must disclose that indication as why you do the impairment and what was the information that was used to calculate the recoverable amount. And then obviously when you do the calculation for the recoverable amount, all the information that you used to calculate that amount must be disclosed as well. The last part is the cash generating unit. So if that is that exists in a company, you must put more disclosures regarding that. So in that case, the carrying amount of the goodwill and indefinite life intangibles allocated to the unit. The basic of recoverable amount, the description of the key cash flow projections that was assumed, and the methodology that was used to determine the fair market value less cost of to sell. So technically, any information that you used to calculate the impairment, which you do need to do the recoverable test and find out the amount, and then based on that, if you indicate that there's impairment, you have to do the calculation and determine the impairment losses. So any assumptions that were used to come up with these numbers, they must be disclosed in your financial statement. Okay. So this wraps up the first part of chapter 5, and after that I will come up with another video that will focus on the consolidation at 100% level and 80%, and then we'll further complete the chapters as we go along. Okay, so this will wrap up the video, and then I will come up with another video that will focus on the consolidation. Okay, until then, take care everyone, and I'll see you in the class.